Welcome to Telltales, an investing podcast hosted by Hunt Lawrence, Jason Wallace, and Mike Nicoletti. Each week, we discuss topics ranging from geopolitics and macroeconomics to energy and technology. You can sign up for our newsletter at telltales.us. That's telltales.us for additional data and content you can use to follow along. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Exhibit C, same story as recent Wednesdays. The demand isn't the problem. Even China, with all the issues they're going through, oil demand is pretty good. It's oversupply, and the price of oil depends on Saudi Arabia and Abu Dhabi. The two companies are actually holding production back, continuing to do that. Exhibit B on natural gas, same story. Demand's pretty good. LNG, feed gas is good. Power's good. Weather is a little warmer than normal across the country, but it's basically a supply problem. Natural gas, dry natural gas production, which was as little as 91 Bs a day in 21, is now running 106. The forecast in Exhibit B had us not reaching 106 to 25. This will correct. It'll take dropping rigs and not having as many completions, but there's going to be a lag in the correction. So the April contract is $1.60, which is an incredibly low number. Consider that the average price was $6 in 22, an average $2.80 last year, average $3.70 in 21, which is the year coming out of COVID, actually still in COVID. So it's an incredibly low number. We're going to talk a little bit later about the energy companies before we get into Nvidia and chips and what we can anticipate from their earnings release after the close today. We're going to cover a bit of energy. Exhibit A, the House of Representatives took a 2-week vacation or time off to go back and see constituents. So the Ukraine bill didn't come up, and they have a March 1 and a March 8 deadline for finishing the 12 expenditure bills. They come back from vacation or time off with only 3 days remaining till March 1. I assume, even though Michael Johnson, the House Speaker, says no continuing resolution, I assume since we're about halfway through the fiscal year that ends in September 30, 24, that there'll be a continuing resolution. Interestingly enough, in the deal negotiated by Kevin McCarthy for the debt ceiling, the continuing resolution will have to have a 1% cut in all spending to include defense spending. So expect to see a lot about that next week. Last week, we started with the end of the memo, and we made it through. We made it up to the energy companies. And for those who don't have the 20 pages in front of you, the page I'm on is page 12. And this page is the gas companies. And the gas companies are trading as though gas is going to average about this year what it did last year, which is around $2.80. They are not reflecting the current gas price. And in fact, what is likely to happen to the price of gas is some recovery as we get into the spring and summer. Are these companies buys? This is Antero 23, QT at 39, Chesapeake at 77. I don't think so. I think the thing to do is to see what happens in the next few months. The decline in gas pricing is unprecedented. I mean, you can go back many decades and not find the kind of decline that's taken place. So I think the best thing to do is let the dust settle. If you own these stocks, I wouldn't be chased out of them. But I'm not sure that I would get into them now. Probably wait and see what happens to the gas market. Gas market is not helped by the Biden administration putting a hold on new LNG capacity after about 2027. That is a commitment to try to get people out to vote in the presidential election, where climate change is one of their key issues. The whole idea here is phase out of all fossil fuels, which most observers think that just is imprudent. That the reason to continue to build up our LNG capacity is to be able to supply Europe and the rest of the world with Russian gas not available. But this is a political calculation that's made, and maybe it'll work for them. We'll have to see when we get to November. Page 11 is oil companies, EOG, Magnolia, Permian Resources, and Diamondback. Diamondback's been in the news recently because it acquired a private company called Endeavor. Fellow who's in his mid-80s who owns Endeavor, Autry Stevens, now is a little bit richer than Harold Hamm, the guy who owns Continental Resources. And it'll make Diamondback stronger. Now that Pioneer is going into Exxon, the Diamondback will become the preferred way to own production in the Midland Basin. Permian includes two major basins, the Midland Basin and the Delaware Basin. The Delaware Basin is to the west. It's about 3 times the areal extent. The Midland Basin, interestingly enough, is that two companies now, Exxon owning Pioneer, Diamondback owning Endeavor, will control half of the production in the Midland Basin. So I think we can expect to see the FTC and the Justice Department, especially in election year, raising issues about that. But I don't see that there really is an antitrust case against having these transactions go forward. EOG is kind of the benchmark that we use, lots of people use, because they're multi-basin. They have Eagle Ford, Bakken, Powder, and they are extremely well run. They will never spend more than half their free cash flow. Here, their free cash flow is almost $6 million, and their CapEx is $6 million, so they're right on 50%. The CEO of EOG a couple of weeks ago in a news conference said that he didn't think, and they weren't projecting, that their 24 production would be increased from their 23 production. That's the way EOG runs, that if they can't make their plans, it'll be somewhat lower production. I think judged by their past behavior, they're very unlikely to have their CapEx be more than half of their EBITDA. Magnolia is kind of a special case. It operates in the chalk rather than the Eagle Ford in South Texas, and it's been very successful. And as you can see, their free cash flow, they're also spending about half of their free cash flow, and they expect to be able to still increase their production. Permian Resources is a new company formed by a private company, Colgate being merged into a public company. So it is harder to figure out what's going on. But once again, they're at about that 50% level, and as is Diamondback. So if you're interested in any of these companies, I mean, EOG is really awfully well run. Diamondback, especially with the Endeavor properties, you can make a pretty strong case for. In terms of stock performance, probably Magnolia has been the best. But all these companies are, potential investments, I'd say, at current levels. Now, current levels reflect $75 oil. When we covered Exhibit C, if somehow Saudi Arabia and Abu Dhabi decided they didn't want to curtail 3 million barrels a day of production, the price of oil would be substantially lower. But they have their own reasons for curtailing production, and hopefully, from the point of view of the price of oil, they'll continue. Page 10 is the midstream companies, Enterprise, Energy Transfer, and Western. These companies are all trading about 15 times or 12 or 15 times free cash flow. I think they're pretty fairly valued. They have dividends. Their dividends don't go up as quickly, and they all have debt, and they don't have enough free cash flow. The margin between their free cash flow and their distribution isn't enough to really take their debt down. Whereas you look at EOG, with the higher oil and gas prices, they basically paid off all their debt. So between upstream, a good upstream company, a good midstream company, at least based on recent performance, you'd rather have the upstream company. Page 9 This is Exxon, Chevron, Conoco, Oxy, and Cheniere. Conoco and Oxy are just large independents. Exxon and Chevron still have refining and marketing. They're very well-run companies. Here, the differential between an EOG at, say, 11 or 12 times free cash flow and Exxon and Chevron at around 11 times free cash flow is remarkable. Normally, these larger companies would trade at a lower ratio. I think it's a tribute to it being awfully well-run that they have come up to the 11 times free cash flow. Conoco's at a premium times free cash flow. Maybe it's deserved. Oxy, which is pretty significant chunk of it, both preferred and common, owned by Berkshire Hathaway, is around 10 times free cash flow. Cheniere is an interesting company, very hard to try to think about, but Cheniere is the largest owner of LNG trains or LNG capacity, the capacity to make LNG in the U.S. There are two big facilities at Sabine Pass and Chesapeake. If our capacity is 15 Bs a day, I think those are like 6 or 7 out of the 15. So it is very significant in the LNG business. Off these numbers, it's trading for 7 times free cash flow. They don't really make money from changes in commodity, LNG versus gas. I mean, obviously, if LNG is higher, it's good for them. But mostly they're on a tolling basis. But an interesting company nonetheless. In terms of dividend yield, Exxon and Chevron are around 4%, Conoco's 2%, Oxy's 1%, and Cheniere is only 1%. With that, we now have half the 30 minutes to talk about how to think about Nvidia. Now, just an introduction, we get to page 1 and 2. Nvidia now is trading for more. In other words, its equity value is more than Amazon and more than Alphabet or Google. Now, Google has recent rate of free cash flow, $53 billion, and Amazon has about $38 billion. Amazon has been coming back strongly. I think it's realistic to think that Amazon will get to $60 billion of free cash flow. Alphabet has some perceived risk that their principal source of cash flow, their search business, is challenged by AI. But the question I want to address, I guess we'll address this to Jason, because Mike and I talk about it at least 10 minutes out of our 20 minutes a morning. How in the world is Nvidia trading for more than these two companies when this time last year its free cash flow was running? I mean, it's a very well-run company and very, it's profitable all the time, pays the dividend, but their free cash flow is running at several $billion. How in the world does this happen? Over to you, Jason.
A lot of sales growth. So this same quarter last year, I think they did about $6 billion in sales, and they're expected to do about $21 billion this year. So if the last 12 months on the sheet, they had a free cash flow of $26 billion, they'll likely have nearly 38 where Amazon's trading. So the enterprise value being very similar between the two now kind of makes sense. Everyone, the stock in Nvidia has run up so much that they say it's got to be overpriced, but it's kind of on par with Amazon. And, if their sales have tripled, they're executing.
Mike and I were talking this morning, and I think Mike will take the lead, but I think Jason may be better qualified. There's a startup that has what is potentially a competing product. But over to you, Mike.
Yeah, there's been some recent news. I think we've talked about this a couple of times. There's a number of AI semiconductor / software startups that are trying to chip away at NVIDIA's lead. We know that the hyperscalers, Microsoft, Google, Amazon, they're all developing their own hardware, but there's a number of startups that are also doing similar things. And the one that got the most publicity in the last couple of days has been a company called Groq, Groq. They're an AI chip company, and what they their claim to fame is they've created chips that are able to, essentially they operate faster with large language models than what the existing large language models do. And that's important because certain applications require lower latency. And if you look at the history of the internet, every improvement in latency or speed of response time has been accompanied by not only growth, but more innovation. So additional products being capable of being built. So the concept of tokens per second or whatever the metrics they're using is a good one to be aware of. The question is this impactful if you're an Nvidia shareholder, or is this kind of just what same thing the hyperscalers are doing and maybe more applicable to scaling individual well-defined models? So with that, I'm going to punt it over to Jason to get his his read on the technological aspects of it and kind of where it fits within the whole ecosystem.
Yeah, so their service is very impressive. It's much quicker than if you use ChatGPT, which has gotten slower for a number of reasons lately. The way Groq achieves their performance is they design chips with the memory co-located to the processing. And what that means is it doesn't have to access separate memory on the motherboard, on the chipset. And the trade-off there is the amount of memory they can package on with the CPU is much lower. So the infrastructure that Groq is running to provide their language model to users is 576 chipsets in a rack of servers. And the equivalent performance on an Nvidia setup would be 8 H100s that you can put in one server box. So you're buying 2 orders of magnitude nearly more hardware to run the models, and the amount of performance you're gaining is significant, but not nearly on par with that investment. And then when you're running hundreds of chips versus 8 chips, your OpEx to run that is, I don't know how much more, but
the analysis we've seen has been it's at least an order of magnitude more expensive.
Right. You're powering the chips, you're cooling the chips, you're running racks of infrastructure versus one server. So the total cost of ownership to use the model, to run a model through Groq is much, much higher. And if you're a hyperscaler, that's the number you care about, and you're not going to make that investment just for incremental speed improvements. And how long does that speed improvement last, do you think?
Well, right. In about a month, we're expecting to see the next generation of Nvidia chips. So if you have an IT budget and you're building out a data center and considering switching over to Groq, you might want to wait a month. Because I think this boils down to the CIS versus risks type of decision set. If you remember Pat Gelsinger, and kind of one of the things that he was instrumental in as far as the early decision processes at Intel was the focus on CIS versus risk and which architecture made more sense. And maybe, again, I'll punt it to Jason for the technical description as to why that's kind of similar to this.
Why is it similar? You're designing for a specific use case. You're limiting the instruction set that the chip can do. So in the case of Groq, they call it a language processing unit. So it's really tailored to running language models. GPUs are general, graphics processing units, and as we've seen, they're good at the kind of math operations that all AI applications are using. So it's much more general purpose.
Yeah, and that's basically the thing is if you can keep ahead on the performance aspect of a general purpose chip, then the specialty chips will only matter when you have a very specific workload that you know you're going to have for a very long period of time, which is why you see companies like Google investing very heavily in TPUs, for example, even though those are also more flexible actually than even these Groq chips. But by specifying your hardware based on the model that you're expecting to run, you can build better, more efficient hardware. So none of that's too surprising.
No, and Nvidia, I believe it was 2 weeks ago, announced that they have a custom silicon division that they've stood up. So it's a services business. They're going to work with customers to custom design chips for their use cases. I don't know. At the time, I thought it was maybe more so a play into China and helping them design chips for those use cases that they have that still fall within the sanctions, U.S. sanctions. But now today, maybe it's more of an answer to they knew this Groq service was going to come out and they're going to be able to build chips for potential Groq customers.
Well, I should point out though, but what Groq's doing, the speed is important. Certain industries really, really, really fast, and just as long as you're faster than the other guy, is really important. And the key example of that is finance. If you're running algorithmic trading of some sort, and you're using some sort of machine learning model to do that, if you can get just a little bit faster, you're happy to pay whatever the cost is, because essentially you're making arbitrage profits at some point. So I wouldn't be surprised if some of their customers are financial institutions or hedge funds or whatnot.
I keep pointing to the huge margins in Nvidia being vulnerable. Mike and Jason push back on that because they say that hyperscalers, the Microsofts, the Amazons, the Oracle, the Googles, for buying these chips are getting their money back in a year. What would have to happen for that not to be the case? I guess there'd have to be an oversupply of capacity to run large language models.
Actually, partly, yeah. But I don't think it's a pure network build-out capacity issue like it was with Cisco and the dot-com era. I actually think it's more to do with use cases achieving good enough results with a current generation of hardware. Because it's not until the performance requirement is so much lower than the performance being supplied that it makes sense to go to a more specialized architecture. As of today, NVIDIA is so far ahead from a performance perspective that designing a specific hardware for a solution when we don't really have tons of obvious super moneymaker products out there, you're kind of at the early stages of that sort of transformation. Did that make sense?
Yeah, I think you can look at the hyperscalers are building their own processors like TPUs and whatnot, and you hear Microsoft and Apple doing the same. They all have these special applications that they're running at very large scale, like Siri and now Copilot and things like that. So they know they have these applications that they need thousands and thousands of chips servers to run. So it makes sense for that. But yeah, these new language models, they don't have that killer application yet.
Right. So Jason was making the comparison between NVIDIA getting to a free cash flow level that was about, the 40 billion range where Amazon is. But Jason, what about projecting from this point forward 5 years from now? I mean, Amazon Web Services will continue to grow. Their digital delivery business will grow. Their advertising will grow. They'll probably impede a little bit on Google with search, just using their own, people going to the Amazon website to search rather than using Google to search. What does NVIDIA do to maintain that 40 billion of cash flow and grow it, so that it would have a comparable outcome in terms of growth of free cash flow to Amazon, or for that matter, Google, both of which are kind of in that 40 billion range.
Yeah, they're going to have to. They've done a great job of capturing an ever-growing percentage of the data center CapEx spend. That's going to have to continue. And how much is being spent on building data centers will continue to grow as well. Our computing needs are not going to slow down. And, we've been talking about for the last year now, text-based models. We're starting to we've seen image models get better. And then just last week, OpenAI released a video generation model where they'll generate a pretty amazing looking 20-second clip. So that's only going to improve in these new use cases, whether it's image, video, audio. They use more compute power than generating text. So as applications do make financial sense and they're built into products that we are going to use, the compute necessary is only going to keep growing. So I think, that's not to say it's a linear path. We're probably going to overbuild at some point. Growth is going to stall, but that trend is I don't see it not continuing.
Yeah, I think it's impossible to call the top of this cycle because we don't. I think we'll have some telltale signs that it's time to slow down because either companies are figuring out how to make money with these GPU servers or they're not. The early indications so far are pretty positive, but there's still a lot of the figuring things out that needs to be done. So, I think we're early stages in this thing.
This episode of Telltales is brought to you by Top Mark Capital. They're not your typical hedge fund. They use a blend of best practices from value investing, venture capital, and private equity, which gives them a unique perspective on market dynamics. And the results truly speak for themselves. So, if you're a qualified investor who's looking for an innovative, emerging manager, visit topmarkcapital.com to learn more. This is not an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. And now, back to the show.
Yeah. Just before we ring off, any healthcare news, any Vertex Pharmaceutical news or Lantheus news or for that matter, software news, Microsoft or others, before we ring off?
Everything's been on on AI. We talked. Jason and I've been kind of going a little deeper on ARM and kind of digesting the earnings from the other week, and started to kind of plot out all the owners. They floated 10%, but remember that a good chunk of that 10% that ARM floated went to institutions like Nvidia, Intel, Alphabet, so they're customers, which sort of made a lot of sense because part of the deal here is they're raising their prices. Now, I don't know how much those price hikes push through to customers like Nvidia and Alphabet and Apple, who have what do they call, the universal license or whatever it's called. But if it does, then them having an equity upside in the business certainly helps, take some of the pain away from paying the increased fees to ARM. So we know that those shares weren't short. So the ones that were short, you had about 10% of the float short, and a good chunk of that was held up by significantly sized institutions. So it sort of made sense that it popped. And we'll see. I mean, ARM's whole strategy is to raise prices, and they believe they can raise prices quite a bit. So we'll see where it goes.
Yeah. They plan to double their prices, but that still doesn't justify where they're at.
Well, right. I think they're going to have to double every year for like 5 years in order to get to a price point that makes sense to justify the valuation.
ARM, because the history of ARM is they kind of gave it away. Their license fees or royalty fees were quite low. Good. Well, that pretty much shoots through our 30 minutes. So everyone be well and stay healthy. And the NVIDIA news comes right after the close. You won't have trouble finding coverage of it. And then we'll talk next Wednesday. Take care, everyone.
Thank you for joining us this week. Please tune in again next week as we will be back on Wednesday. As a reminder, nothing on this podcast should be considered investment advice. You should always do your own work to determine if an investment is suitable for you. The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.